All right, let's dive right in. Today, we're putting Scorpio tankers through a rigorous Buffett-style stress test. As value investors, we're not just throwing darts at a board looking for a quick stock pick. We are hunting for a wonderful business trading at a sensible price. So let's open up the hood on their SEC filings and see if the fundamentals actually hold up to scrutiny in this explainer. To do this, we'll run through our value investor checklist. First, business and moat evaluation. Second, a deep financial analysis. Third, management's capital allocation. Fourth, valuation and margin of safety. And finally, our final investment verdict. Okay, let's kick things off with Section 1, Business and Moat Evaluation. This is the foundation of Scorpio tankers. So what are we looking at here? Scorpio operates a massive fleet of 93 modern product tankers. And here's the kicker. The weighted average age of these ships is just about 10 years. This isn't just a large fleet, it's an incredibly eco-efficient one. In the shipping world, operating modern, fuel-efficient vessels is your economic moat. It literally ensures higher customer acceptance from major oil companies and significantly lower emissions compared to the aging global fleet. That sheer scale and efficiency, that's their primary durable competitive advantage. Now, if you want to understand this business, you absolutely have to understand one specific metric, TCE, or time charter equivalent. It is the very heartbeat of this industry's profitability. Whenever we look at a shipping company's top line, we aren't just looking at gross revenue. We're looking at how much each ship earns per day after subtracting voyage expenses. It's the ultimate metric that dictates their cash flow. So how do they actually maximize that TCE? It really comes down to two main revenue streams. Think of the spot market kind of like a toll booth with dynamic pricing during peak traffic. It's highly volatile, sure, but the upside during a supply crunch is just astronomical. Time charters, on the flip side, are more like selling a reliable, flat-rate monthly pass. They lock in a fixed rate for a year or more. Scorpio leans heavily into the spot market, with 72 of their vessels operating in these pools. Make no mistake, that is a very deliberate, aggressive strategy to capture the massive upside of volatile rates. And here is where things get truly wild. Global trade route disruptions act as a massive catalyst for them. Geopolitical tensions force ships to take way longer routes, which increases what the industry calls ton-mile demand. Because Scorpio has such immense scale, their operating leverage is just staggering. Listen to this. A mere $10,000 per day rate increase across their fleet equates to roughly $332 million in incremental cash flow. That is the very definition of high-velocity earnings. All right, let's move on to Section 2. Deep financial analysis, looking under the hood to see how this translates to the bottom line. When you look at the Q1 2026 results, that sheer financial velocity we just talked about is staring us right in the face. Net income effectively tripled year over year. It leaped from $58.2 million in Q1 2025 to a massive $216.3 million. Diluted earnings per share climbed from $1.22 all the way to $4.32 in a single quarter. Guys, this isn't slow incremental growth. This is a company aggressively capitalizing on peak cycle dynamics. And it doesn't stop there. Just look at the explosive expected jump in daily rates going into Q2 2026. In Q1, their LR2 vessels pulled in an already impressive $50,830 a day. But Q2 guidance expects that to nearly double, hitting $96,000 a day. The MR and Handymax classes, they're also seeing expected rates nearly double. If you apply that $332 million operating leverage formula we just discussed to these rate jumps, well, the cash generation potential becomes absolutely mind-blowing. Which brings us to Section 3, Management Capital Allocation. Are they actually shareholder-friendly? Because look, a great business generating mountains of cash is fantastic, but it's not enough on its own. We need to know if management is treating us like true owners, and the data shows they are actively flexing their fortress of a balance sheet to benefit shareholders. After aggressively de-risking by paying down $2.5 billion in debt over recent years, they are now sitting on $1.4 billion in unrestricted cash. But more importantly, they're giving it back to you. They recently hiked the quarterly dividend to 45 cents a share and replenished a massive $500 million securities repurchase program, scooping up their own stock when it trades below intrinsic value. Let me give you a prime example of their financial savvy. Check out their April 2026 convertible note strategy. They issued $375 million in convertible notes at a highly attractive 1.75% interest rate. Concurrently, they turned around and used a chunk of those proceeds to repurchase 1.34 million shares of their own common stock at $74.36 a share. This two-step financial engineering move is brilliant. It highlights their laser focus on reducing their weighted cost of capital while simultaneously buying back equity well below its perceived intrinsic value. Okay, let's pivot to Section 4, Valuation and Margin. Is the price right? As a value investor, it's all about that margin of safety. When we compare Scorpio to peers like International Seaways and Plains All American Pipeline, there's a really stark divergence. While peers are actually showing implied downside risk compared to their one-year price targets, Scorpio shows a 12% implied upside from its current price of $84.41 to the consensus target of $94.60. It really stands out from the pack. Digging into the forecasts, analysts are expecting earnings per share of $8.35 for 2026, alongside a return on assets of 8.89%, which handily beats the industry average of 7.8%. Now, even if we expect earnings to normalize a bit in 2027, as these extreme rate spikes inevitably settle down, the current valuation, backed by these industry-beating profitability metrics, looks incredibly sensible. Now, we always do our own homework, right? We don't just blindly follow the herd, but I have to admit, it's certainly reassuring that the street overwhelmingly sees the fundamental value unlocked in this stock. 4 out of 5 analysts rate it a strong buy, which aligns perfectly with the robust financial data we've just been reviewing. Finally, Section 5, our final investment verdict: the moat meets the market. So let's pull all of this together. We have to weigh the fundamental bull case against the unavoidable cyclical risks. On the bullish side, you've got a pristine balance sheet, a modern, eco-efficient fleet, shareholder-friendly capital allocation, and cash-gushing operating leverage fueled by current global trade route disruptions. Conversely, the bear case presents a highly volatile spot market dictated by unpredictable global forces. A sudden resolution to regional conflicts or a global economic slowdown could quickly compress those lucrative daily rates. Shipping is notoriously cyclical, and history tells us that peaks simply don't last forever. But given that aggressive $500 million buyback authorization, the massive expected Q2 rate jumps, and a stock currently trading with a projected margin of safety below its consensus target, Scorpio makes a very compelling case. So, I'll leave you with the ultimate value investor's question to ponder for your own portfolio. Is this the cycle you want to ride? Thanks for joining me for this explainer, and as always, keep doing your homework.